Jim Sailing. I'm with Sailing Sims Associates. We're out of Columbus. We do have clients in 28 states, and we do operate a lot up in this area as well, but we're in wealth management. You may have stopped by the booth that we've had here and seen Brent Sims, who's one of the partners, and Brent and Jen Berry as well. They're at the booth, and I guess as soon as she gets the door closed, I'm going to point out in the back of the room Peggy Slaughter, who is our retirement plan specialist. We're kind of proud of what's happened over this past year. She was named by National Association of Plan Advisors as one of the top women plan advisors in the country, and so we're real proud of that. And if any of you do work with retirement plans, please take note that the Society is offering a webinar a week from tomorrow on the Department of Labor's new fiduciary standards that are going to impact financial planning and retirement plans quite a bit in the coming year. It becomes effective next April, and Peggy is giving the webinar on that. So look it up next Friday. I don't know, is that around noon? Or
I think it's 11:30.
11:30. So please, if you're interested in that at all, look at the OSCPA site. Well, you know, I talked to a lot of people around the room so far, and I got a lot of mix on the economy, on where we are, good, bad, indifferent. You know, so what we're going to try to do is sort that out. How many people saw us last year or have seen us before? Several of you? Okay. We're going to start this year with the very last slide that we had last year and start talking a little bit about that. And as we look at the economy, I've heard a lot of people say that it depends on who's in office and such. Now, we're going to take a nonpartisan stance on that, but we will talk about those things and see what issues we see will help the economy. How many people watched the debate last night? How many people watched the Indians game last night? There's more there. Okay. Well, on that note, let's just get started here. And this was the last slide that we had last year. What we were saying about this is that all the low fruit has been taken. We've been talking about the economy. You know, when we look at from the Great Recession to where it's grown, it's been a pretty easy ride up through that from 2009 to now. And we're at that point now where we think that this economy is still moving, but all the low-hanging fruit's been taken. But we also talked about last time how easy it is to be an economist anymore. What happens is, this is going back to 1870 on the left end of this slide. And this is the growth of the GDP in the U.S. from 1870. And when you look at that, this is in a logarithmic scale, so 10% at the top looks exactly the same as 10% at the bottom. It's pretty easy to figure out where we're going. You know, it's not a tough thing. You have a couple places where we come off this 3% growth. This is really driven by innovation and productivity. But we've come off this 3% growth a couple times. The first where you're down here in the big dip there, that's the Great Depression. But we didn't grow from the Great Depression at 3%. And beyond the Great Depression, that's World War II. And we came back and we had the machine working. It still didn't grow beyond that 3% from that World War II spot. So we've snapped back to this line each time. And you can kind of see where we are up at the top. This one goes through 2011. But here we're seeing that same graph, that red line still represents that logarithmic 3% growth. And this is coming up through where we are now. And what we're saying is that that normal growth line, we've come off of it and we have not snapped back. Now I'll tell you that we probably will at some point. We're still waiting to see what that is. And we'll look at some of the things that will make that happen. I talked to a few people out here who were saying, well, expansion is getting a little long in the tooth, and so we should be looking for a recession to pop up. This graph shows expansions in gray bars and recessions in blue bars. And so recession is not really anything to get upset about, but just to know how to navigate it is what you're doing. And so we're looking at the length of the recessions and expansions in months. The average expansion lasts about 46 months. This one's a little longer than that. This has been about 82, or 87 now. Been giving this talk for a while. So recessions average about 15. And when you do look at that, it is only have 3 expansions that have been longer than this. So that would make you start feeling a little nervous about, should we have a recession coming up here? But the difference between this expansion and the prior expansions that you're seeing there is the magnitude of the expansion, how fast it's been going. If we would put on here how much growth came out of each one of these expansions on the vertical axis there, and those number of months, we've laid that down now so they're on the horizontal axis, what we find is that this expansion there on the bottom, it kind of sticks out from the rest of them. It sticks out because of the slope of that. So even though it is the one of the longest expansions we've had, three being longer, it is one of the lowest expansions that we've had. There's only one been lower through your post-World War II here that we look at as far as the magnitude of that growth.
Are all these in nominal dollars?
Are these in?
Or constant dollars?
These are in percentages and months.
Okay, but I mean,
So we're looking at the percentage growth of the GDP on the horizontal axis.
Okay, so it's not...
Not adjusted for inflation. What you're looking for, though, is what percent the GDP does grow.
Right.
Okay.
Without,
Right. So when we're looking at that, we've got a lot of room to grow just on the size of that. And this is what it's been at. When we're looking at GDP, we've seen this chart before. About 70% of GDP is made up of consumption. And that's what's been slow coming back in this expansion. If you remember back when we were having the last presidential election and Romney was running on, I want to get government spending under 20% in here when we were doing a lot of stimulus spending, he knew that it would get down there. We were about 17.7 on government spending. Housing is only about 3.8% of that GDP growth, and actually import-exports, since we import more than we export, is a negative effect on that. But when we're looking at the expansion over here on the left-hand side, the year-over-year change, this is as of second quarter, was 1.3. I think we're at 1.6 now percent. Here has been very, very sluggish. The average that we've had in the past 50 years has been about 2.8, or roughly that 3% growth. What we've had in the expansion since we had the Great Recession in here, the expansion that we've had here has only averaged 2.1%. As a matter of fact, you can throw rocks at him or not, but Mr. Obama will be the first president to leave office in the U.S., being a two-term president here, the first president to leave without a 3% growth year in his presidency. So that says that we have had this change here, that we have not snapped back to that line. You know, when we're looking at where this one is, the potential GDP versus where we are, and again, you know, taking it up here, it's not just because of the Great Recession. There's been things that have happened all along that whole route. The biggest impacts, again, the Great Depression and World War II. But this is what happened back in the 80s when we snapped back. And it's very similar to other expansion periods. When we dip below that 3% line, we've grown at faster rates, on average about 6% to get back. And so that's what's missing from this expansion, that accelerated growth rate. Now, if you put those two recoveries in there together, you can see that dramatically on what's happened as far as growing back to that side. And this is where we think some of this is. What we've graphed here is the number of federal workers are employed in regulatory activities. And we're going to exclude TSA because we know that's up, so you can all keep your shoes on, and we'll just look at the graph. So it's expanded quite a bit, the number of people in regulatory activities. Compare that to the 80s, what happened to regulatory activities when the economy was sluggish, and they said, let's get the government out of the way of business and come back and try to grow that economy. Now you can go too far one way or the other. I'm not making any campaign here for anything there, but you can go too far one way or the other. But this is just looking at the observations. Now we think that there are three things that really are going to affect us as we look at that. First is obviously the election. You know, it's right around the corner. What's going to go on with that? The direction of the markets, the direction of rates, and so on. You're hearing a lot about the Federal Reserve. We'll touch on them. And the connection. We're going to talk a little bit about international trade and what that role that plays in here, where we are as a country in there. Now I know a couple of you probably noticed what movie poster that was when we put that up. Anybody remember? Perfect Storm, right. And that didn't end too well, did it? Well, we have had storms that have ended a little bit better. And so we're really hoping for that. The trouble is we don't know who's going to be captaining the ship. But hopefully we're going to come up with something that's going to have rainbows and we'll salvage the economy for it. Now, someone pointed out to me last time I gave it that there's 2 elephants out front and no donkeys, but unintentional. They're coming off the ship yet. Okay, so let's look at that election. And the problem with the election, when you compare that to the markets and the economies, is uncertainty. Because this is all over the map, and polls have been going back and forth. And so, when we look in the dictionary to the word uncertainty, certainly it's a noun, and this is how they describe it. So we're not sure where these things are going, and you can't prepare for both. When we're looking at short term, but we do think it's going to be a short-term effect in here. So in this, what I thought since we're CPAs here, what I thought I would show you is a little bit about the tax packages that either candidate have. Now understand, and this came from the Brookings Institution, and these are fluid. They've changed throughout the campaign. So this is the last time we took a snapshot of it. So to give you an idea of some of the differences between the candidates. Trump, while he's raised his top rate from when he started, it was going to be 25, has 3 rates, 12, 25, and 33%. Mrs. Clinton has a 4% surcharge on incomes over $5 million and has 8 brackets, with the top bracket being about 43.6. So this is a significant difference in tax packages. Both of them think that you should limit deductions for those that are in those top-end tax brackets. Mr. Trump limits deductions to 10%. So if you had $1,000 in interest, you could take $100. Or I'm sorry, yeah, that's right, $100. You can take 10% of your income. You have the limit on it. Deductions on Clinton's side are limited to 28%. Of course, she has higher top-end brackets, and so there's impacts across there. Capital gains are a big difference. Where Trump is somewhat silent on capital gains, Clinton's tax package says that there's 47.4% capital gains for things held under 2 years if you're in the top tax bracket. That's a significant increase from where we are. You hold it over 4 years and you have 35%, and over 6 years you can get down to the bottom rate, which is 27.6 on cap gains. This should, when you heard in the debate last night about raising tax revenues, this is where this is expected to come from. On business taxes, see, Trump wants to reduce the corporate tax rate to 15% and have year of purchase expense. Take that depreciation that he's been able to enjoy and say, now we purchase this, you can expense it in that year rather than depreciating out over a long period of time. Also, that all the money that needs to be repatriated and it isn't brought back to the U.S. because of the tax burden that we would have on here. He wants to impose a 10% tax on that whether they bring it back or not at one time, but let them spread that out over 10 years by charging 1% per year, hoping that would say, now I can bring it back without penalty, and then tax new income all at 15%, regardless of where they're getting that. Mrs. Clinton doesn't want to lower those tax rates, but does want to establish a tax credit for profit sharing and apprentice programs, saying we're looking at the workers here and we want to give some incentives there. We want to share the profit, so we'll give you some tax credit for that. Estate tax-wise, Trump eliminates the estate tax and the 3.8% Medicare tax. And Clinton, on this side, will take the estate tax to the 2009 levels, meaning that we would go back to a $3.5 million exemption. This will be interesting if it gets installed, because there's been a lot of attorneys out there who said, well, we're up on married people, you're up at what, 10.8 and on exemption, so gosh, let's do away with all these trusts. So if you've done that, they may come back into play here. They also, where now you normally get a stepped up basis, and heirs can take non-qualified assets and have not pay the taxes on the gain in there. what she wants to do is tax that gain at time of death to the estate as an additional income tax, a capital gains tax. And then the heirs do have that stepped up basis, but it's been paid for. So there are some significant differences, but when you look at what's going on here, it's going to be tough for either one of them to get their tax package through because they have to get it through Congress. And when we look at this, we'd say that if if Hillary Clinton was elected, what you would probably see is much like the last 2 years of the Obama administration. You have a Congress on one side and a president on the other side. And you're going to get a lot of noise, but not a whole lot of things done. Now, if Mr. Trump is elected, then it's probably going to be more like the first 2 years of the Obama administration, where he had his own party in Congress, but they didn't always agree on things. So it was tough to get anything done. So you look at that side of it, I think the next 2 years aren't going to be real active either way. U.S. party identification. This is interesting. We used to run about a third Democrat, a third Republican, and a third independent. And that's changed over the years to, in this case, this was in 2015, 29% Democrat, 26% Republican, and 42% independent. So more and more people are going on the independent side. So this election is going to be highly decided by independents. 42% independent, 28% Republicans, 28 and 2% are undecided. They can't even figure out if they're independent. So I don't know with that, but they're going to have to play to that center piece there. And when you take that one step further, what Gallup says that we are now approaching places where 60% of those polled now say that we need a third party in there. Now it's interesting, with 60% saying we need a third party, and Johnson's running in third place at about 6 or 7%. I doubt he gets elected. That's the one statement I'll say here. If the election were held today, while the polling is about 6% difference, 6 to 7% difference in the favor of Mrs. Clinton, which is about where you were with Reagan and Carter. Carter had a 6% lead about this time at that point, so that's still within the margin of error. You don't know, but when you look at electoral votes, where she's polling better in that popular vote is significant. It looks like she has about 256 electoral votes somewhat sewn up, at least leaning that direction. We need 270 to be elected. Donald Trump has 170 that are that way or leaning heavily that way, and we still have 112 votes up for grabs, which means that he's either going to have to grab some of those leaning states or he's going to have to grab almost all those that are up in the air. So we don't know which way that's going to go yet. We have an idea that it looks like, unless she does something to run that amok, it looks like Mrs. Clinton will be our next president. It'll be interesting to see how they dash to the finish. But here's what's important, the other side of that election. The other side of that election, we have the U.S. House of Representatives. Now, in the House of Representatives, the majority is a Republican, and Democrats need to gain 30 seats to take control. I doubt that happens. I mean, it's mathematically, it's very, very tough for them to do that. Now, it'd be a real challenge for the Republicans to lose the House. Now, they may be up to the challenge, but it's a real challenge for them to get that mathematically. And this is why. Everybody remember Rorschach test? What do you see? Anyway, tell me what you see up there. Well, I'll tell you what I see. I see gerrymandered congressional districts. And that's what this, I'm kidding. The test that we had, doesn't it look like this? That's the 7th district in Pennsylvania. That's out by Philadelphia. And it's interesting, the way that got there was this. This is the 83rd Congress, that same district over on the end. And this is how that district moved to where it is today. And that happens because it happens off the census. And you and I both elected either Democratic or Republican state legislatures, wholly or almost entirely in control. So off the census, that's what gives us the blue and the red states, because they've been able to draw the lines. It's not that you're circling all your people. What you want to do is make places where your opponent has definite majorities, or you're giving up some seats for your opponent, and you get very winnable districts out here. Not all your people, but the ratio is such that you're going to be elected. So the next time they're going to redraw these are 2022, I think it is. So until 2022, it looks like we may have a Republican House. And this is, the darker the spots here, the more gerrymandered districts are. And if you look up at Ohio, we have a lot of black in Ohio. You know, so we're one of those areas. Now, the other side of the aisle, the Senate, is going to be a little bit different because in that case, currently, there's 54 Republicans and 44 Democrats. There's 2 independents, but they caucus with the Democrats. And so really, to pick up the majority, they really only need about 4 seats. And when you look up what's up for election, 34 seats are up for election, 24 of them are Republican and 10 of them are Democrat. And so it's going to be easier for the Democrats to pick up 4 seats in the Senate than it will be for the Republican to defend all 24 seats. You know, it only needs to pick up 4 for a majority. They won't have enough for a veto override, you know, or they won't be able to stop just lost it here. Thank you, filibuster. Yeah, won't be able to stop a filibuster, but those 4 seats are probably going to come in on the coattails of whoever gets elected. So we would expect whoever wins the presidency is going to win the Senate. Now that's real interesting in here. Really, 47 Democrats and 47 Republicans are either safe or likely leaning their way. There's 6 toss-up states in here. Ohio came out of the toss-up state for the Senate. Mr. Portman has a fairly large lead in Ohio. So Missouri, Indiana, North Carolina, Wisconsin, Pennsylvania, New Hampshire. And so you're hearing a lot from those states. That's why they're on the national news a bit. Now, this is the real importance of that, is that they have the Supreme Court. We do have 1 vacancy already that needs to be filled, and that's filled by the president and confirmed by the Senate. And so if you get an opposing party in the Senate, House has nothing to do with this, if you get an opposing party in the Senate, chances are you're going to have a more centrist appointment. If you have the same party in both sides, you're either going to have a left or a right appointment inside of here. So when you go to the polls, this is the thing you should be thinking about, what's going on with the Supreme Court. And Scalia is the one that's vacant right now, but if we look at this, Ginsburg's 83, Kennedy's 80, Justice Breyer is 78. So if we have a 2-term president, and I'm not sure if either side we are going to have a 2-term president, but if we have a 2-term president, chances are they're going to get 4 appointments. And 2 of these were appointed by Reagan, 2 by Clinton. And so this is the real issue in the election when you're looking at that. Now all that stuff that's, everybody say, gosh, everything's going crazy in the U.S. right now, and people are looking at it strange, but Warren Buffett sums it up very, very well. He says that a child today born in the United States is the luckiest child in the world. You know, when you think about where we are as a society, we are the most productive. We do have the most opportunity here, and we've solved a lot of problems. When we look at the peak oil worries of the 1974 report to the President by his economic advisor said we'd be out of oil worldwide by 2000. We know that's not the case. So that's been solved. Lots of manufacturing jobs, where we were offshoring a lot of jobs because of labor rates and productivity. Because of our productivity increases and wages increasing around the world, we're still not the lowest paid, but you couple that with productivity, you're seeing onshoring coming back. Manufacturing is coming back to the U.S. Housing bubble. But I was talking to somebody a little earlier about this. The fact that we had the housing bubble is that everything went at the same time. We've always had bad markets in the U.S. in real estate, but you've had a bad market in Denver and a good market in D.C., a bad market in Houston and a good market in San Francisco. But during the bubble, that all went at the same time, and it all retracted at the same time. But we feel that housing bubble has been solved at this point. We're back to a normal pace here, at least, of growth on that. U.S. banks were leveraged very highly. The financial crisis that we had here had a lot to do with that. Banks right now have the best balance sheets they've had in 50 years. They're not lending a lot of money. It has to deal with regulation, what we talked about earlier, but that's been solved. Leveraged corporate balance sheets, the same thing. We're seeing a lot of cash, a lot of buybacks, a lot of Not as much capital expenditure in there, but that's been somewhat been solved. Now, U.S. deficit back to long-term average, and everybody goes, that's not solved, but it is. If you've been to some of our presentations before, you saw that we were running at a 35% deficit at one point. You know, and you can't get out of debt without bringing that deficit down. And that came up in the election last night when Clinton was asked about the debt, and she pivoted to the deficit, the improvements that have been made on the deficit. We're still running a deficit, so we're still not lowering that debt, but we're getting closer. So we can say that's solved. So what we do have left is long-term debt, entitlement, and health care. All three of those came up in the debate last night, and the reason is that we have not solved those problems yet, and they're looming. The other thing that we're looking at right now are, as baby boomers are retiring, what we have is an expected life expectancy here. And what we're seeing is the green is men, the gray is women, and the dark blue is couples, one or the other, living to certain ages. Well, when we look to 80 years, one or the other of them, there's 89% probability that somebody's going to get past 80 years out of the couple. When we look to 90 years, there's still a 47% probability one or the other is going to get longer, or live longer. But when we look at what they funded for their retirement, this will become an issue, especially as you look back at entitlements. And it'll put pressure on the U.S. Now the U.S., right here in the third bar, what it looks like is we can fund about 14 years of retirement, but on average we retire at 65. There's 7 years that we don't have the money for yet. You know, so that's going to be interesting. And trying to get that solved it goes back to what's going on in Washington right now. I'll just focus on the top left graph that we have here. This is how many times the House in blue and the Senate in black vote along party lines. And we're voting over 90% along party lines. And the last time that we did this is a long graph, people, it's 1901. So when you think about all those go-go years, we crossed parties and made consensus. I have a whole story about how I blame MTV on that. Someone can come up and ask me about it later. But we've created this battle between Wall Street and Main Street, and we can't get consensus built in Congress, and that's where our real problem lies. When you think about the battle between Wall Street and Main Street, you know, it's real handy to put a onus on a faceless street, Wall Street. But when you start to think about it, you know, what is Wall Street? It's business. It's where the stocks and bonds and all the finances are done there. And if we can succeed in taking profits out of Wall Street, then that'll be a great thing, because all the firemen pension funds, all the teacher pension funds, all of our 401ks are not going to grow. You know, so you think about that. Who are you taking that money from? You're taking it from the shareholders when you do that. And so this whole battle has to be reframed somehow. There are excesses there, and you do have to take those out, but you have to reframe what you're really doing. Now, Carlos Gutierrez, who was Secretary of Commerce, I believe under the Bush administration, he said, in the U.S., there's no reason to apologize for making a profits. That's what spurs growth. And we have to get that message across in that side of it. You know, we're still the soundest country in the world to invest in. You know, we still have good growth. We still have a good solid economy here, although it's growing slow. But as Americans, when we look at that, we overemphasize that. What we're looking at on the left side here is global GDP. How much of the global gross domestic product is the U.S. and how much is the rest of the world? 22% is U.S., 78% the rest of the world. When we look at the stock and bond markets, you know, the financial markets for those same issues, the U.S. does a little bit better there. We're 36% of the world's stock and bond market, and globally it's 64%. But when we look at how U.S. investors are allocating their portfolio, you may think of your own allocation in here, 74% in the U.S. and 26% globally. Now, does that mean we're taking full advantage of where the economies are growing as an investment? Certainly not. We have a home bias, and a very big home bias, because if we look at these maps up here, what we're seeing is that upper left-hand side is the financial investments. When we look at that on the national average, most of the financial investments are up here in New England, where a lot of the financial companies have a big presence. California is about 2% under. We in the Midwest are about 12% underallocated to financials if you look to how much of the market it has. For technology, well, who didn't know California would have the biggest investment in technology? About 10% out west above the average. We're about 8% below the average. New England's right on average, and the South is about -7%. Well, where does the South go? The South goes in energy, through Texas, through Florida, and all of that. They're overweight in energy. And what do we do in the Midwest? We overweight in industrials. So it's not only that we're looking at the world skewed, but we're looking at the U.S. skewed, and we're investing in the companies that we know by name, by sight. Tim O'Neill said it about politics. He said all politics are local. You start looking at investments off, and that's the same thing. Here's where the real problem is, though, with investments, is the fact that new business formation, remember we talked about regulations, we feel this is what's being impaired by regulations, is new business formation. Tying that back to that long-term growth, what did we say that was? Innovation, productivity, those kind of things. This often comes from new businesses. You know, we talk about small business, but new business formation is important. We're down about 40% over the last 5 years in new business formation. And so that doesn't hurt us today, but it will 5-10 years down the road when we start looking at this, unless we can spur more new businesses. So we'll get off the election and where we think it should be going or would be going, and we'll start looking at the direction of the market, the direction of interest rates. And this is the direction of profits, corporate profits, because you've heard me say many, many times that there's one thing and one thing only that drives the market, and that's earnings. Earnings go up, market goes up. Earnings go down, market goes down, and that's a longer cycle when you're looking at that. But what happened to fear and greed? People say fear and greed, it doesn't. It drives volatility in there. Fear and greed drive volatility around where earnings are. So earnings are still have a pretty good look on the market as growth. So we are growing earnings. We do have strong projections out there for the coming year. I think if you look at the consensus earnings there, we're projecting to meet maybe about 20% earnings growth across the country. But this is what the S&P has looked like since 1997. You've seen this graph before, and back here when we were in 2011, November of 2011, we were telling you that was the lowest price on the market. You're paying the least amount for earnings. So even though the market bottomed back here in February of 2009, and we've had this nice growth, about 200%, it was getting cheaper as it was going up until we got to about here. And then we started upping the price on the earnings that we were paying for. But all said, then we feel that we've broken out of that range that we've had the last 10 years. This is going back to 1900. And the same graph that we were looking at right there is this on the top. But what we see is clearly going back there that we have periods of what we call secular bear markets and secular bull markets, and everyone's followed by the other. Where we feel that we are right now, you can see that last circle, that we feel that we're in a secular bull market. So we do think that the market is in a good place for growth the next 5 to 7 years at least. But you know, it doesn't mean it's going to go straight up. You are going to have recessions in there. You are going to have markets go up and down. But as you did, and here's Black Monday, which by the way, yesterday was the anniversary of Black Monday, back in 1987, and it happened in the middle of a secular bull market. Okay, so I want to look back to the beginning of this year just to frame something for you that's coming up at the end of the year here. And this was the headlines that you saw. If you all remember back to January 1st, it just came off of New Year's celebration, banged your pots and pans outside and everything. Anybody still do that, bang your pots and pans? Okay, so the U.S. stock posts the worst 10-day start in history. Not in the last 5 years, not in the last 10 years, but in history. And other headlines were, it's really the stock market's worst year ever. These are pulled right out of the headlines. Sell everything. This is on January 12th, 2016. 2016 will be a cataclysmic year Warren's Royal Bank of Scotland. Stock market's terrible start to 2016 just got worse. That's February 10th, so we're a whole month in. This is all you've been hearing for a whole month. What are you going to do? And what happened? People got a lot of fear off of that. And what was going on? Through that time, we had, let's see here, January 1st to February 11th, the market was down 9% in 42 days. That's scary. 9% in 42 days. Just imagine if you're just retiring too. But from February 11th to April 27th, it was up 14% in that 45 days and gained back everything we'd lost there. And so now we were back to more even keel. And so what was going on then? The headlines would say so much for that imminent meltdown. You know, this is February 26th. Stocks, oh, I love this one. Stocks soar. You know, you get an elevator and it doesn't say up and down, it says soar and plummet. You're going to ride that elevator. To its highest level. And then they qualify it in 2016. You know, so this is what you get on the media. They sell advertisement. And why do I point that out to you? Because I said, the only reason it was news is because it was right there. We had a demarcation line. We had January 1st. And remember I said earnings are the only thing that drives the market. But we had January 1st, so now it's a slow news day. Now we can start measuring from there instead of measuring from some other point. Now, if it had happened in June and July, it certainly wasn't the worst period in June and July. It certainly wasn't, you know, so different headlines on there. Now, why do I say that? It's because we have another headline date coming up right now, November 8th. And I'll guarantee you that the market will move either up or down. The market will fluctuate, and you're going to get outrageous headlines. And you'll probably get that through now, and when does the next president take office? January 20th, and then probably somewhat in the first quarter. And just remember that you want to keep some type of a long-term view on this and look at what's underlying those. Because really, this chart shows from 1980 to this year, each one of the bars is whether the market went up or down, and the magnitude that it did. So 1980, that first bar was up 26%. 1981 was down 10%, up 15, up 17, up 1. We come out to 1990, it's down 7. We come out to 2000, 2001, 2002, down 10, down 13, down 23. The Great Recession there in 2008, down 38. But the key to this graph is those red dots. Those red dots that are all over the place are saying sometime during that year, how much did the market come off from where it was peaked? I'm sorry, you shouldn't say from a prior point. Maybe it's not the peak of the market, but from a prior point. And if we look at those, on average, it's about 14% per year across the board. Now, you see one of the dots in every year. If you take out the outliers, the ones that down 3% and down 49%, you take out those outliers out of here, and we average about a 10% downturn every year. Now, I'll guarantee you that the media will pick up on that and say, don't worry, this is not a raging bear market. Don't count on that one. So what we do see, here's this year, we're up about 6%, but if you remember, early on in the year, this actually happened twice in this year, we were off about 11% each time. So when people talk about gambling in the stock market, I love to pick this up. I say, well, let's see if it is gambling in the stock market. And anybody play casino games in here, I don't know, but we put out the casino games and we said, who has the worst odds? And that's Keno. You only have about a 23% chance of winning Keno. 40% on the slots. And boy, you know, you walk through Vegas and that's all you hear is a ding, ding, ding. But 40% chance of winning there, 44% on roulette, 46.5% on let it ride. We're getting down to the best ones. Anybody want to start taking a guess? Okay, poker's at 46.6. Blackjack at 48. Craps, you have a 48, still less than half chance of winning. The odds are in the house favor. 48, and Baccarat, the best game in the house, is 48.8. What does that say? James Bond. That's what he plays. You know, you always think of him as a risk taker. He's playing the safest game in the house. And you know, the other thing is, he's drinking a martini with that shaken, not stirred, or whatever he says. What do? They put ice in the shaker, they shake it up, he's got a watered down martini, and he's being smug about it. Anyway, when you look at this, And you say, compare that to the market. Say, just going in the index and say, let's look at it every 1 year. Well, 75% of the time you'd be up. If you look at it every 3 years, 83% of the time you'd be up. 5 years, that moves to 87. 10 years, 94.5. 15 years, 99.8. And the reason I bring this up is because you are going to have a media splurge coming up at the end of this year. And the reason they do it is that demarcation line. And it's either that or zeros. If the market goes back below 18,000, there's 3 zeros there. they can jump all over that one. You know, instead of saying she's 60, she should say I'm 59.95 in shipping and handling. You know, it doesn't sound as old. Or gosh, I'm what is that? 21,915 days old. You know, doesn't sound quite the same as 60, but it's because it's 60, you make a mark. Now, this is something we've told you all along. It's an important graph to watch. This is consumer sentiment. This is put out by the University of Michigan. I don't think I'm allowed to say that during the season, so this is put out by that school up north. And so what we're looking at here is how confident are people. The gray bars represent recessions. And what we were saying before is that we have an average in here of about 85. Doesn't matter what the number is, but it is an average on the measurement. And what we saw is as we go through that average line, that it doesn't typically stay at average very long. It typically spurts on one side or the other. And so where we've been, and we were telling you back here that we were getting closer. Here's that 2011, right in there where we were talking about. And when we got to that average line, it started shooting up. Now, we've had a few things in the media so far that has pulled that line back a little bit, and that's why we flattened out a little bit on consumption and on markets. But we are above that, above the normal average there, so we should see things improving as we go right now. We're nowhere into over-exuberance here, or irrational exuberance, as Mr. Greenspan would say. This is what the consumers' balance sheets are looking like, and they're getting very healthy. We have about $103.8 trillion in assets on the consumer's balance sheet, and only about $14.7 trillion in leverage here, with most of it being mortgages. And what we've done since that Great Recession out here is we've been paying down debt, so it's taking less and less of our income to service that debt. Well, if you have less and less of your income servicing the debt, what has to happen to that other money? You either have to save it or spend it. You know, so we expect that that's going to continue for a while. And what we are seeing here, this is household net worth. Here's the Great Recession. Everybody got real worried about that. But 401ks became 201ks, and you heard a lot like that. But I haven't heard anybody saying it's back up to 601ks yet. You know, and that's what it is. We're starting to get that wealth effect, and so that's affecting that consumer sentiment. When we look at the cyclical sectors, especially up here when you're looking at vehicle sales, we're back up above average on vehicle sales, although we have a big gap to make up. That could slow down immensely in the fourth quarter, and GM would still end up being profitable in this year. And so what we are saying that you do have a little time above average there. Housing starts are back up to our normal housing starts, or close to it. Inventories, we did have a move up in inventories and now a tick down. And the Federal Reserve minutes say that we expect that inventory to tick back up through the second half of the year. And so that should be a good growth sign here. This is where we're lagging a bit, is on real capital goods orders. Again, those balance sheets that we've got, healthy balance sheets, have not been reinvested in capital goods for much. We're seeing the housing prices tick back up here, and the average interest rate on mortgages is down, so it still makes these homes very, very affordable. And so at this point, those markets are still affordable, and as a matter of fact, it's way below the average. Those of you that remember buying your house back in the early 80s and paying 9-10% mortgage on it, that makes that house price a little more expensive. Now, if we do get increases in interest rates, that should have some effect on housing. Now, we're still making new households. As far as making new households, they're just living in your basement right now. But sooner or later, they'll move out. Trust me, believe me, they'll move out. Okay, so the other thing that we've been affected with is oil. this was not a demand issue. This was a supply issue. The countries were increasing supply of oil, and in reality, it was the U.S. and in here that had increased 19.4% in supply since 2013, as opposed to OPEC only increased 6.5%. So we're largely to blame for some of that. I think it'll be a benefit in the long run. Consumption the U.S. has only grown the consumption at about 4.1%. China's grown at about 15.1%, and the global average is about 5.9, or roughly 6% in growth. So that's going to hit equilibrium. We're seeing oil now is out to around $50 a barrel. But what this chart represents is what's it take to get oil out of the ground. What's a break-even price for oil? So we know that companies are going to have to get to that break-even price. Well, in Kuwait, it's down around $10 a barrel to get it out. Saudi's down there too. The U.S. is up here very high, and here about 64, 65, but we are seeing some progress in that. Currently, fossil fuels make up 80% of the world's energy. You start talking about alternative fuels, and we do projections going out. By 2035, it should be only 78. So that's a little less of the world's energy, but that demand will have grown by then. And so there's still demand for fossil fuels. Now, some parts of North Dakota, Bakken Shale, they've been able to get oil out at about $29 a barrel, and the Scoop and Stacks down in Oklahoma, south central Oklahoma oil plain or oil production or whatever it is, those areas in Oklahoma are doing the same thing. And so we're going to be able to be profitable at those lower levels. I think they can be profitable at $35, $40 a barrel oil, and so that can change this whole scenario. Now, the thing is that when you look at petrostates or budget balancing, Brent's about 51. That Kuwait that can take it out at $10 a barrel, it still needs about $51 to balance their budget. And as we look at these, Saudi Arabia goes clear up to about $95 to balance their budget. Why is that? Because they own the oil company. And because a lot of people work for the government or in some way are funded by the government, about 75% of Saudi has that. And so they need higher prices to balance the budget. What have they been doing? They've been going through reserves. Their reserves were much larger. And they've been going through those reserves, but they can only hold out for so long. The last meeting, they went in with the idea to cut some production, which should boost the price a little bit. Unemployment. When we look at our unemployment, we tick back up to 5%, but that's not because we lost jobs. We were at 4.9, but it's because more people have re-entered the labor force. As things improve in the economy, you're going to get those people who were unemployed and actually not on the rolls, because you do that by a survey. They take a statistical sampling, say, do you have a job? If you say, no, you're not unemployed yet. They say, have you looked for it in 6 months? If you say, no, you're not unemployed. If you say yes, then they put you down as unemployed. When people start saying, yeah, I'm looking, that will tick up the unemployment rate. So a movement up in unemployment right now is actually a good move, because when we look at participation. So we look at that unemployment coming down. August was 4.9, now we're at 5. What we're starting to see on the bottom end is wage pressure. We're starting to see pressure on wages to go up because labor is getting a little more scarce. Where Ohio sits in there, we're at 4.8% unemployment, and so we're right in the middle across the states. You can say that we are that average, we are that national average where everything is. As we're looking at the national average, places that are the highest are places like Louisiana. I think they're at 6.3%. Mississippi's right up there too. So those type of states are some of the hardest hit. But when we look at the number of states that are above a certain percentage unemployment, and we take this back to here's January of 06, and we come through the Great Recession. This top line here, I'm sorry, I want to go to the bottom line. Bottom line here is 11%. So we had at least 12 states that were over 11% unemployment at that point. But those have tapered off. Nobody's over 11%. Nobody's over 10%. Nobody's over 9%. Nobody's over 8. Nobody's over 7. We still have a few over 6. So this unemployment is across the country is actually getting better. Now, someone asked me ahead of time too, said, well, what about those people you're not reporting? We call it U6. And you know what? You're always going to have U6. And it's almost always the same amount of people who have dropped out of the workforce here for one reason or another. This is the underemployment there. So we're at 5% for unemployment and 9.7% for the underemployment. Where it usually comes in is when we're at the highest. We say, gosh, it's 10%, and somebody else shout, oh, you know what, it's really 17, and at the lowest. We're at full employment now. Oh, no, we're not. We got 10 unemployed. That number's always there. And it's always about the same distance. So what we're doing, from the recession, we lost about 8.8 million jobs. We've gained 15.2 million jobs. That takes into account not only the people that were out of work, but we're also adding people that are entering the workforce. Finally, they'll get out of the basement. So we look at the growth in working age population. This has a lot to deal with where we're going. Between 95 and 2004, that grew at about 1.3% per year. When we're looking at 15 through 24, we only look at about 0.5% per year in growth in that working age population, because we have the baby boomers dropping off on one side and we have the millennials coming on the other. Millennials are a little bit larger than the baby boomers, but still, it's not going to be a huge increase as you look at it. When we look at in here the growth in output per workers, that becomes important, because what's going to drive this GDP growth is not only the amount of workers we have, but that productivity. Remember, we talked about that in the beginning. And so what we're seeing 2006 through 2015 has only been growing about 1.4%. If you drop that productivity and drop that available employment in there, naturally you're going to slow the economy down. We're growing, but slow. Now, this was just this week. Ms. Yellen said potential output is 7% below what we would have been expected based on where we were pre-crisis trajectory. Now you understand what she's saying on that news media, that if we had the same trajectory, we're about 7% below where we should be as an economy. Now, the nice thing is about the Federal Reserve, I'm one of those geeks that reads the minutes, and they just came out. But as opposed to prior meetings, this meeting we actually had some dissent. We had 3 Fed presidents that said, no, that's enough, we want to raise rates. Now, they've been given a lot of lip service, but Esther George from Kansas City said, this is earlier this year, she said, I support gradual adjustment of short-term interest rates toward a more normal level, but I view the current level as too low for today's economic conditions. The economy is at or near full employment, and inflation is close to the FOMC's target of 2%, yet short-term interest rates remain near historic lows. She's chomping at the bits to raise the rates. Fed President Rosengren, if any of you came and saw, we talked about the Taylor rule and how to calculate where rates will be. If you want to look up a speech that Rosengren did in the past couple of weeks, I think it's here in October, he talks about that Taylor rule and he actually fills in the variables. So just Google Eric Rosengren and Fed speech. In my view, the market remains too pessimistic about the fundamental strength of the U.S. economy, and the likelihood removing monetary accommodation is higher than is currently priced into the financial markets based on the current data. So he's saying, look out, it's coming. You guys aren't paying attention. And we're homegrown here. Loretta Mester, she was the other dissenting opinion, the Federal Reserve Bank of Cleveland. If we continue to delay, even as we make further progress on our inflation goal and labor markets continue to tighten, we risk having to undertake a considerable steeper policy path later on. Meaning we're going to have to raise rates faster than what you think we're going to do, and that will put the brakes on the economy. So where the Federal Reserve, this is going back to 1999, where interest rates were, as they came down through the recession, 01, 02, and then as we heated up, they went back up. They can go up and down very quickly. Now, where the Federal Reserve says, we've been low for long, and this is the way Wall Street's really playing it. You know, we had a raise last December, but where the Federal Reserve thinks will be when you ask them, it's a much higher growth rate than where the markets have priced in. And so this could be devastating for bonds if that path indeed takes place. Now, these are the dots. This is what the Federal Reserve, each dot represents a member of the Federal Reserve. And we have, 10 voting members, I think it is, Bank of New York president, the chair and the vice chair, is it 3 governors, I think, and 4 presidents that rotate on and off the board that vote, and Ms. Mester is a voting member this year. But each dot represents where they think interest rates are going to be over years, 2016, 2017. And what you see is this starts stretching out. We even have some that are down here, one standalone. I don't know who that is. They don't put names on these. But as a group, we think that that longer rate by 2019 could be approaching 3%. These are some pretty significant moves. So just because we've been low for long, don't think it'll always continue. Richmond Fed President said, if we don't adjust policy in a timely way, we could find inflation pressures emerge pretty rapidly, and we have to act pretty vigorously to counteract. It becomes significant as we're looking at it. This was from the minutes of September. They were just put out now. There was a couple things in here I wanted to point out. Let's see. It's noted that a reasonable argument could be made for either an increase at this meeting in September or waiting for some additional information on the labor market and inflation, which is what they've been saying, data dependent. And it says 3 members preferred to raise target rate of the federal funds rate by 25 basis points at this meeting. They cautioned that postponing policy firming for too long could push the unemployment rate markedly below its longer run normal rate over the next few years. And if so, the committee might then need to tighten policy more rapidly, thereby posing risk to continued economic expansion. A couple of these members expressed concern that potential adverse effects on the credibility of the committee's policy communications if the next step in the gradual removal of accommodation was further postponed. And that's what you're starting to hear in the media, that central banks around the world are losing credibility. They're here to say that, and so they're concerned about it. So when we talk about inflation getting to where the longer goal is, their longer goal for the Federal Reserve is 2%. We want to see 2% growth. Well, someone, I think I heard him on CNBC say, why do you want inflation? If you're a middle-class person and you get inflation, isn't that bad for you? But the reality is, if I want to buy a large screen TV, and I think that large screen TV is going to be the same price or cheaper next year, am I going to go out and buy it? Well, depends on how bad I want to watch the Indians win the World Series. If it's not that bad, or I got a buddy with a large screen, I'll wait. Because I can make more money, I can have it invested, whatever. But if I think that it's going to be much more expensive next year, I'm going to go out and buy it. If I go out and buy it, my buddy down the street who works at the factory has to go and produce it. And so this is a boost to the economy when you have a normal inflation. You heat it up and you have all other issues. But when we're looking at inflation, inflation's been very, very low. August of 2016 was showing 1.1%. I think it's up to 1.6 now as an inflation year over year when you look at a basket of goods. Now, we've got 2 lines up here. One is CPI, Consumer Price Index. That's what we were just talking about. The 50-year average on that has been 4.1%, so we're very, very low. But core CPI is this dark line here, and we can see that that's running about 2.3%. Well, what's core? You take out food and you take out energy in there. Oh, Jim, I know on my way home I'm going to have to stop by the marathon station and fill up. Why are you doing? I know I'm going to get the call, get some milk and bread on the way home, and those prices are going up. Well, the key is those go up and down. What was gas a year ago? You're going to have to go back and look because you don't remember, because it goes up and down so much. And so what happens if you take those things out? They still get to about the same place long term, 4.1%, but you take away some of the noise. So when someone says CPI is this, you want to look a little further and find what core CPI is. We are increasing prices. We're at the Federal Reserve's target, at or above. We're at full employment at the Federal Reserve's target, and that's their 2 mandates. They have nothing to do with the market. They have to have stable prices, a stable inflation, 2%, and Stable prices and full employment. That's what they're after. And so we're at their targets. And Richard Fisher, who actually retired, he was the Dallas Fed president, and summed it up and he said, we have no fiscal policy here in the U.S. And that's what the Federal Reserve's been trying to do. They've been trying to fill the gap on those things that we were looking at a little bit earlier where we can't build consensus and go anywhere and build some credible fiscal policy, either side of the coin. When we look at federal finances, this is what we were talking about, that the federal debt is continuing to increase, and we do project it to continue to increase even as we're trying to put the brakes on the deficit. The deficit, we have cut it way down from where we were in 2009, 2010, but where we are now, we do expect it to start inching back up. And when we get to where all our social programs have needs, we're even going to be in a little tougher place. And here's what we were saying. Here's what we were saying about the polarization, and that's what's stopping us from doing that. When we look at where the market expects interest rates to go, in the U.S., when we're looking clear out at September 18, the market only expects us to be at about 0.6. I believe we're going to be much higher than that. So you will have impacts on the markets because of that. The Eurozone still at a negative 0.37, and Japan at a negative 0.17. Imagine that. I'm going to take money down to the bank, and I say, can you hold this for me for a year? And they go, well, give me some more money to do it. That's what negative interest rates are. Now, there's a lot of ways to get into that. But and when we look at government bonds with lower negative yields, below 1% is the dark side, and negative yields is the blue side. And we're seeing more and more governments with negative yields on here. This is a problem that is unprecedented. We haven't seen this. We're in somewhat uncharted territory. So the Federal Reserve has mentioned that it is illegal in the U.S. for them to target a negative rate. So they would have to go back to Congress and ask. But they still have asked large institutions to see what the effect of negative interest rates would have on them. So I don't think we'll hit there, but global fixed income, when you're buying fixed income around the world, part of that investment side, we used to be the only game in town or close to it. We're the gray down here. The rest of the world are the developed countries in the dark blue, and the purple is emerging markets. And what we saw is back in '89, we were 61% of the world's debt that was issued. Now we're 38% there. We're less than the developed non-U.S. Side, which is 44%. That'd be Canada, Europe, and all that side of it. So that direction of rates and direction of market, we think that we're going to have a volatile but somewhat level market till the end of the year at least, and we do think interest rates will have to go up. The connection has to deal with we talked about local investing and global investing, but when we look at that same chart for the MSCI index, which is our international index here, MSCI EFA, Europe, Australia, Far Eastern, what we see here, this looks very, very similar to ours. And I'm not calling that we're at the bottom of that market. They got a lot of work to do yet internationally, but things are looking better, and we do expect that to break out into a secular bull market at some point. And when you talk about China, China was all in the news last year when everybody was asking about China. What's going to happen? They're slowing down. They're slowing down. Yeah, they slowed down. As we were looking at, to about 6% or 6.9%, and 6.7% most recently percent in growth. Wouldn't it be nice if we had that growth here in the U.S.? They have some other issues. We talked about it last time on how the state runs finances. But we feel that they have reached that soft landing, and that will continue to grow. And so we think China's going to be fine. But when we look at international equity earnings and valuations, we're seeing earnings grow a bit. We've had some tail off here on the emerging market and a tail off on the EFA as well. This is the U.S. At the top. But when we're looking at valuations, I mentioned that we're about our average for what we're paying for price. So now it becomes selection in the U.S. It's not as easy to look for good investments, although I think it's still pretty sound. The IFA, though, is running about 14.5 times, which is their average, so they're a little cheaper than we are in the U.S. when you're looking at that. And we would look at price to book for the emerging market just because you don't have the history on the other. But price to book side of it, they're running about 1.3 times price to book versus a 1.8 average. That's what's on sale. You know, is that turned around yet? Not quite, but that's what's on sale if you're saying I'm going to put my money someplace and have some value in the long run. And so when we're looking at that emerging market, this is where this connection becomes important. Is that the emerging market in here, we can look at the regions of there. Asia, you can look at Latin America, and you look at the emerging market in general. And as we're looking at earnings in here, where the emerging market earnings are versus where Latin America's earnings versus where Asia are, you can see you get some separation here. And so it becomes regional rather than global. And you look at things like the European Union. You know, you've got countries in the European Union, Austria, I'm not going to go through that whole list, but there's a laundry list. So there's, the last one's the UK. We've had Brexit there, so we can't put the UK there, even though it's not gone yet. But that's what France calls them, that country up north. Yeah. So anyway, when you're looking at that, that becomes a trading unit. It's the same as what we say the Asian +3. And that's Association of Southeast Asian Nations +3. And